Hi. In the second part of Chapter 1, we will talk about the building blocks of accounting. Basically, we will start with discussing the importance of ethics in financial reporting. And then we will talk about the various government agencies and organizations that are involved in setting accounting standards. More specifically, generally accepted accounting principles, or GAAP. And US GAAP are the standards that are to be followed by companies in the US. Finally, we will discuss two measurement principles and two assumptions that provide the foundation for the accounting process. So to start with, why is ethics important? Basically, ethics is standards against which our actions are judged as right or wrong, honest or dishonest, fair or not fair, etc. Now again, why is it important? Let's say that I am a gambler and I have doubts that the casino is cheating. Do you think that I will continue to gamble in that casino? Probably not, because I don't trust the casino itself, and I have doubts that no matter what I do, because they are cheating, they will beat me and basically they will take my money. Well, the same thing applies to investing in companies. Let's say that investors lose faith in the stock market. Who will invest anymore? Who will buy stocks in for any company? For example, let's say that two companies, that you know that there are two companies, one of them is cheating, but you don't know which one. Now, you will not be taking into consideration any of the two numbers. You will either simply invest in either of the two companies, or you will not invest at all. As a result, why would that happen? Simply because I don't trust the numbers, so I don't know which numbers to trust, and as a result I will not be trusting either statements, either from company A or company B. In such case, I will not invest at all, and if all the investors follow my lead, at that point the stock market will collapse. Another example could be, for example, eBay versus Craigslist. You can safely send money and pay and send money because you can use PayPal to another eBay user even before receiving the goods, as you have faith in eBay itself and in PayPal. Now on the other hand, Craigslist themselves, they urge their users not to send money or to wire their money before they actually receive the products, because they cannot guarantee that the other party are not scamming or they are not fraudsters. Now, in the early 2000s, there were several accounting scandals, most notably Enron and WorldCom. As a result, the US government, they responded by passing Sarbanes-Oxley Act of 2002, which is also known as SOX. Now, the reason why they did that was to re-establish trust in the stock market, to basically increase or improve monitoring and internal controls, to increase the independence of auditors, increase liability and responsibility of management. As a result, the accountants now are expected to follow certain standards in financial reporting that are stricter than before. When we talk about accounting standards, there are several organizations and government agencies that are involved in setting standards. The SEC, or the Securities and Exchanges Committee, that is the entity that oversees all financial markets and accounting standard setting bodies. It was set up in 1934. Its main job was to require that investors receive significant information about securities being offered to the public, and to prohibit deceit, misrepresentations, and other frauds in the sale of securities. Now, the SEC relies on the FASB, or the Financial Accounting Standards Board, which is a private body consisting of market participants that sets the standards for disclosures, later on to be mandated by the SEC. So the SEC basically relies on the FASB to formulate those standards, and then it mandates them. The PCAOB was created by SOX to oversee audits. That's the Public Company Accounting Oversight Board. And the International Accounting Standards Board is similar to the FASB, but this is the international. It formulates the International Financial Reporting Standards, also known as IFRS, which are the guidelines that are mostly used outside the US. So US GAAP are the standards that, or the guidelines that companies need to follow when they report their financial statements in order to satisfy their information users and to comply with the regulations. It makes it, because of the standardized type of reports in the form of financial statements, that would make it easier for the user to use such information in order to compare the performance of various companies. Now, the difference between US GAAP and IFRS is detailed in the book. Basically, US GAAP are the standards used by public organizations in the US, while IFRS, or International Financial Reporting Standards, are used by public organizations outside the US. There's a trend recently of minimizing the gap between US GAAP and IFRS, and as a result, this is what they call convergence. They are trying to make the differences kind of a little bit, they're trying to minimize the differences between the two types. The main financial statements that are reported and filed by companies are the balance sheet, income statement, statement of stockholders' equity, statement of cash flows, and footnotes. As we mentioned earlier, we will be talking about two measurement principles. So we have there is the cost principle and the fair value principle. The cost principle, or the historical cost principle, it states that assets and liabilities are to be initially recorded at cost, and they have to remain at cost until they are sold, consumed in operations, or disposed of. So basically, if you buy a land at $5 million, initially you record it at $5 million, that was the cost, and then every year you keep recording it until it is sold, or if it was supplies or something like that, until they are consumed. Now, even if that would be the case, even if, for example, in 2 years the value of the land became $7 million, you still record it at cost. And under GAAP, this is the principle, or this is the measurement principle that has to be followed, except for specific assets. On the other hand, fair value principle states that assets and liabilities are should be initially reported at cost, but then each reporting period, any changes in fair value must be recorded. So this is mostly useful for assets where the information can be easily accessed or easily available, such as traded stocks or securities, because you can simply go online to the stock market and you can download this information, or you can obtain the market value of these assets, compared to, for example, a land where you would need to find the information. In order to find the fair value, you need to get an appraisal, which is by itself subjective, and moreover it is costly, especially if you have a lot of assets. and in order to evaluate every one of them, it will become very costly for companies. Now, under GAAP, as we mentioned, it has the assets must be always recorded under following the cost principle, except for, like we said, securities and stocks, etc. Those two, like basically the selection between those principles, it also depends on the relevance, which is to mean whether this information is relevant and it would affect my decision making whether to invest in a company or not, or whether to give that company loans or not, as well as faithful representation, which also which is basically how well these numbers, they reflect the reality of the company. So as a result, there's a trade-off between the two. Now, the two assumptions that we will discuss are very important for accounting to work properly. The first assumption is the monetary unit assumption. Basically what it states is it's simply that any event we must be able to express it in monetary value in order for us to record it. In other words, a transaction has to be expressed in a dollar amount in order for it to be recorded. Now, this is very important for the cost principle. In order for it to work, you must be able to assign a monetary value for any transaction that you record. However, that also leads, unfortunately, to the loss of certain qualitative information, such as the quality of services provided by a company or the health of the CEO, etc., which can have an effect on the company's stock, but it is hard to capture and to compare or analyze. Basically, the monetary unit assumption enables us to quantify the information, and as accountants, it's much easier to work with numbers and to analyze them than with qualitative information. Plus, qualitative information can be very subjective compared to the objectivity of numbers. The other assumption is the economic unit assumption. And here, basically what we're saying is that any economic entity, the activities of such economic entity must be kept separate from the activities of other entities or of the owners of that entity. And when we talk about economic entity, basically we're talking about any company, government agency, municipality, city, university, etc. So all these economic entities, they have to keep their transactions separate from those of their owners, as well as from the activities of other entities. And usually companies or business, they take the form of proprietorship, partnership, or corporation. Now, the differences between these three are listed in this table. Basically, a proprietorship is a business owned by one person, usually small businesses that provide services such as plumbing services, the deli around the corner, etc. And those, they have limited life because they depend on their owner. All the profits of the business, they would go to the proprietor or to the owner of the business, and all the losses are endured by the owner as well. And here we talk about unlimited liability, because if the business goes bankrupt, the liability of the owner extends to their own to the owner's personal assets as well. Now, partnership is very similar to proprietorship. However, it is owned by two or more persons, and those are the partners. And there is usually a partnership agreement that would govern what happens in the case of the death of a partner, or what happens when the partnership is to be dissolved, etc. If one of the partners decide to sell his or her share, usually that is explained in the partnership agreement. And once again, partners, they take the profits and they endure the losses of the business. Once again, here they are, their liability is unlimited. So basically, proprietorships, they have no legal, there's no legal distinction between the owner and the business. Now, although there's no legal distinction between the two and their liability is unlimited, there are still the activities and the accounting records of the owner must be kept separate from the business's activities and records. Corporations are the ownership of these organizations are split into a certain number of shares that are easily transferable, and as a result, the life of these corporations is said to be indefinite because it's not affected by the death of the owners, which are also the shareholders. And this is usually, it's a separate legal entity that we will discuss that in more details in later chapters. And here the shareholders or the owners are said to have limited liability because their liability is limited to their investment in that company, and as a result, if the company goes bankrupt, they are not liable and their personal assets are not they are kept intact.